Home prices are completely unsustainable. They were bid up to these artificial heights by a combination of temporarily low adjustable rate mortgage payments, by a complete, absence of any lending standards, and by speculative buying. And what's going to happen in 2007 is a lot of these artificially low ARM payments are going to be reset upward. You're going to start to see both the government and the lenders reimposing lending standards and tightening up on credit. And you're going to see a lot of the speculative buyers turn into sellers. And these sky-high real estate prices are going to come crashing back down to earth.
First of all, I have no idea what Peter Schiff is talking about.
Most of the profits that people have in real estate are going to vanish, just like the profits in the dot-coms in 1999, 2000. It's a fantasy. People can't sell their house. The inventories are exploding all over the country. Houses are on the market for 6 months a year. There's no bidders. The prices are going to fall through the floor.
I just don't know where he's getting his stuff.
Well, one of us is off base, but it's definitely not me. I mean, it's not wealth that's increased in the last few years. We haven't increased our productive capacity. All that's increased is the paper values of our stocks and real estate. But that's not real wealth, no more than the NASDAQ was wealth.
The ride to the top of the real estate market began to gain height around 1997 when a Republican-led Congress passed the Taxpayer Relief Act, eliminating taxes on the first $500,000 in gains for married couples selling their home, and the first $250,000 for singles. The very visible hand of government policy provided an incentive for flipping real estate and pushed Americans to view their homes more as an investment than as a necessary place to live. This taxpayer-funded windfall for homeowners coincided with falling interest rates, lending standards, and regulations. Add the newest credit products conjured up by Wall Street to finance the American dream, perpetuated by the widespread belief that housing prices could never fall, and you have the recipe to fuel the mother of all housing bubbles.
WAMU free checking. We've got your back. Woohoo! WAMU.
Hey, have you heard about the crazy new way to send a message today? It's flashed on a screen too quick to see, but still you get it subliminally.
Sophisticated for advanced needs, yet simple enough for your child to use. Compose music, play advanced games, manage your finances, all at the touch of a button. Discover Atari. Atari!
Why buy just a video game from Atari or any television? Invest in the wonder computer of the 1980s for under $300.
The home computer from Texas Instruments.
See for yourself how Microsoft Excel and Word for Windows are changing the face of how business does business.
Easy as Dell.
The compact Presario. Has it changed your life yet?
HP printers. Just what you had in mind.
The mid-90s marked the convergence of several powerful trends set in motion by nearly 2 decades of deregulation and technological innovation.
The flexibility of America's free market system. To preserve this flexibility, we must keep our markets open and hold government restrictions to a minimum.
Federal Reserve Chairman Greenspan lauded the confluence of the personal computer and the Internet as a productivity miracle that defined the new economy. Telecom companies invested trillions of dollars to provide the bandwidth. Dot-com companies developed a new business model in which they could thrive by building market share alone, without any revenue or a workable business model.
Earnings results from several high-profile tech companies could impact trading today. After the bell, Microsoft reported an 8% increase in sales.
These were the heady days when a startup tech company with some initial venture capital funding could balloon into a billion-dollar giant overnight, enriching management, Wall Street firms, venture capitalists, and the few shareholders lucky enough to get in on the initial stock offering. The new economy resembled a global casino filled with day traders given VIP treatment from brokerage firms, offering online trading, margin accounts, real-time data, and competitive commissions, just like the pros. In this new era, everyone thought they had found a path to get rich quick. Stock prices of nearly anything internet-related soared into the stratosphere. Many of the big Wall Street banks made huge profits with proprietary trading desks. The traditional rules for determining value or assessing risk no longer applied. In business, in stocks, or in housing.
Early returns are very encouraging. We got some very positive news from the financial service sector earlier this week. Citigroup, Bank of America. Yesterday, we got some good news on the technology side from Intel and Texas Instruments. So it looks like earnings are coming in better than expected so far.
You'll see behind me, people are toasting. Certainly a happy end to a solid week on Wall Street.
Technology stocks and growth stocks have been doing very well.
From 1994 through 2000, the Dow Jones average more than tripled in value. The tech-heavy NASDAQ increased nearly 700%. For 2 decades, incomes remained stagnant, but falling prices for the newest technological gadgets made them seem more affordable.
Electronics, always hot, super hot for the holidays.
Low borrowing costs gave stock and real estate investments the look of a sure bet.
Let's imagine you're driving and haven't taken alcohol. Watch out for that delivery man. Your rapid perception of the situation and quick brake reaction prevented what could have been a fatal accident. This time, let's imagine you're fully under the influence. Reflexes are slow, judgment poor, and you're too late and too slow to avoid hitting the delivery man. Your confidence was high, but your reactions and judgment were low.
The Federal Reserve dropped and then kept real interest rates low, injecting us with the liquidity we craved, reinforcing our conviction to consume. Detached from reality, our judgment altered. We denied that our convictions were making us credit convicts. We became prisoners of the prevailing dogma.
He lives from fix to fix. The addict must have his drug, and to get it he must have money, and that much money comes hard.
We ignored the signs of impending disaster as we denied the consequences of our deepening dependence.
Over the past decade, the world experienced a period of strong economic growth.
We have individuals who were drunk. The regulators were the bartenders who continued to pour the drink, didn't stop them from drinking.
The massive inflow of foreign capital combined with low interest rates produced a period of easy credit.
And now he was drunk, he got on the main thoroughfare and had an accident.
And that easy credit especially affected the housing market.
The accident clouds the highway.
Many lenders issued mortgages and many borrowers could not afford them.
It's the highway where we have our pension plans. It's the highway where we have our car loan and our mortgages.
Financial institutions then purchased these loans, packaged them together, and converted them into complex securities designed to yield large returns.
Low interest rates punish savers by reducing the income they receive for their savings, rewarding those who sought out riskier investments that yielded better returns. By 2000, nearly half of all households were stockholders in one form or another. In the 2 decades since 1980, the percentage of households owning mutual funds, a way to invest in a diversified portfolio of companies, increased 7-fold.
Mutual fund investments are subject to market risks. Please read the offer document carefully before investing. Mutual fund investments are subject to market risks. Please read the offer document carefully before investing.
But how was I to know that?
Wall Street and Madison Avenue, through the old and new media, informed investors about the advantages of dollar-cost averaging, the fancy-sounding pitch to buy on a regular basis, regardless of price.